Please join me and give Manuel Medina-Mora a warm welcome. Welcome. Thank you.
Well, thank you very much, Bob. That was very nice, and I really thank you for that kind introduction. It's really an honor and a privilege to be here at our school when Bob is actually starting his last year of what has been a terrific period for the school, having he as a leader. I wish we were able to convince Bob to stay more. I would like to talk today about the global financial crisis that we are going through, which happened to start in the U.S., but as I will hopefully be able to show you, has roots that go well beyond the U.S. And then at the end, maybe share with you some of the lessons for the banking industry, and even on the personal front, some of the lessons of dealing with crises that I have learned through my career. I was exactly where you are now 30 years ago. And I was, at that time, along with all my classmates, living through another recession. That was only in the U.S., though. Started in 73, running to 76, the year that I left the school. And it was quite an important recession. The stock market at that time dropped 50%. Sounds familiar? And actually, the U.S. economy reached a 9% unemployment. It's 6% now. Can reach 9%, which will mean millions of Americans without a job in the next few quarters. Now, what are the implications of this global crisis, and especially for Latin America? That's what I would like to try to do today. And what I would like to do is, first of all, talk about the current financial crisis, as I said, the global implications of Latin America, and then we go to the lessons learned. Let me start with the global economy, and let's try to understand what happened in the last two periods in which there were an important expansion of the global economy. The first one is from 91 to about 99, 2000. That's when the dot-com bubble actually came about. If you look at the growth rates in terms of GDP for the world and for the U.S., you will notice that the U.S. was actually growing faster than the world economy, the blue line. On the most recent one, though, is different. This is a period from 2001 to 2007 in which the world grew at a speed that we have not seen in many, many years. 4.5%, 5% annually for the whole of the global economy. And the U.S., for the first time, was not above that. It was a strong growth for the U.S., though. And the U.S. consumers represented a significant factor behind that growth. But if you look at the world, it was growing faster because of emerging markets, because of China and India and Southeast Asia, and to a lesser extent, because of Eastern and Central Europe and Latin America. That period was amazing. The whole world growing at 4.5%, 5%. We might not see this in many years in the future. It might happen that with this boom, the world actually exceeded the speed limit and started to create some imbalances, mainly in three areas: in the financial world, in the housing sector, and in the commodity markets. Those three imbalances are what led to what we are living today, in my personal view. It's not a subprime crisis, as some people have thought. It's much more than that, and it goes well beyond the U.S. Let me just remember with information, and this is data from the IMF, that in the last 20 years, for example, if you take this period, there have been a number of crises, financial crises, in developed countries and in emerging markets. You can see there the number of crises, the duration, the average years, the length that it took to recover the economic growth that was actually seen before the crisis started, the fiscal cost in terms of percentage points of GDP, which are amazing, and the total cost, the output loss. So financial crises are not something that are quite unique. They happen. We tend to forget, as many people forgot in the recent years. Some of the players in the financial industry thought that economic crisis was a part of the past. That always happens in a crisis, always. But they are part of the economic world that we live through. What is probably different this time? Let me start with the similarities. Normally, we have financial crisis when there is a disregard for risk. And in a period that now many people are starting to call the Great Moderation, the years on which the developed economies live through a long period of very low interest rates, 1% in the US. There was a reduced sense of risk, really. And people thought that risk was something that was not to be considered significantly. And that led to a very lax origination criteria of loans and credits all over the world. And that is an excess of credit. It's quite clear in the US, in some countries in Europe, and as we will see, in few countries in Latin America. But it's not only in the US. Some of the public policy initiatives actually foster this. For example, in the US, and it started with the Clinton administration, but it was much more clear with the Bush administration, the policy of one house, a home for each family. And that, of course, helped to propel what we are living through. And regulatory and supervisory deficiencies in the financial world, quite clearly. They are normally present in all crises. What is probably different this time, and you are living through a very much historical crisis, which happens only once every 100 years, as some of the people have said, is the financial innovation behind what we are seeing today, and the global interconnection. This is not a US crisis. This is a global crisis. And it's affecting people all over the world, and is going to diminish significantly the growth rate of the world for the next 2 to 3 years. The second difference is the degree of response by policymakers. Different from what happened at the Great Depression in the 30s, where the stock market went down 91%. This time, we have a weak economy, but the right policy response by most of the governments in the developed world, the US, Western Europe, Japan. And finally, just for a change, emerging markets didn't provoke this crisis. They have become much more strong. They have learned the lessons from the past. And they have become from debtors, net debtors, to net creditors in foreign exchange all over the world. So they are, within the global crisis, in one of the most strong positions. Not so the developed economies. If we look at the first imbalance, the financial one, it was over leverage all over the financial sector. Normally, commercial banks have a leverage of 10 times its capital. That is, for $1 of capital, they normally handle $10, $12 of total assets. And that will be a reasonable leverage. And that was present, actually, in the case of the U.S. before the crisis started. Not so in the case of Freddie Mac and Fannie Mae, and not so in the case of investment banks, brokers, or hedge funds. They were leveraged 27 times on average. But look at the footnote. Here is very important to understand the footnote. This does not include off-balance sheet vehicles, the conduits, the SIFs. In the case of Lehman Brothers, some analysts now believe that the real leverage of Lehman Brothers was 40, 50, even somebody has said 70 times its capital. This was the extent of the over-leverage in the financial sector. It was a bomb waiting to be exploited. And this is exactly what happened. When you look at consumers, households, they also over-leverage. Look first at the personal saving rates. A few years ago, you don't have to go that far, just 10 years, mid of the 90s. The saving rate in this country was 6%. At the beginning of the 90s, probably, close to 8%. For the last few years, less than 1%. And now look at how they actually increase their debt. These are households. Again, if you go back just to early 90s, all the debt of households in the U.S. represented 55% of GDP. It has almost doubled. It's now 98%. And if you look closely, this happened precisely at the time that we are talking about the global expansion, the last period, 2001 to 2007. The shape of the curve actually changes there dramatically. Again, this is a case of the financial imbalance, over-leveraging all balance sheets, financial institutions and households. Let's look at the housing bubble. Here you have an index that The Economist, the UK magazine, had built using data not only from the US. These are 13 developed countries. Canada and the US, several from Western Europe, and Japan. And you look at interest rates, and you see the period of the Great Moderation, as we call it. And look at the price of housing in these developed countries. Again, the shape of the curve changes when? Starting in 2001, and for the last 6-7 years. And this is exactly what we are witnessing today. The problem of the subprime has to do with financial instruments. But let's not overlook what is behind that, and is a housing bubble in many countries in the world. Again, as I said, the period that is more relevant is 2001 to 2007. In the US, in this period, the average house price nationwide more than double. But in the UK and Spain, almost triple. So again, it's not just a US problem. It is a problem for developed countries and a clear bubble on the housing sector. And you see now, if we focus on the US, how the price of houses have come down. This is using the Case-Shiller index, which is probably the best to measure the price nationwide of housing in the US. And the amount of inventory that is there of houses to be sold, new and used. Normally around 4 months of inventory, now almost 3 times that, 11 months. These, by the way, are the 2 variables that I believe are the best to follow what is going to happen with the housing market. Prices and inventory. If we don't find stability on the prices, the turnaround in the economy cannot happen. That's a key variable for all of us to follow, to understand when is a turnaround on the economy, on the US economy, going to happen. Very briefly, the dynamics on the financial crisis. This one started with a decline in housing prices. That leads to a drastic markdown of financial assets in which banks, financial institutions have to take significant losses because they are valued according to market prices if they hold securities that are linked to mortgages, which was the case in the US. This doesn't happen that brutally in Europe, for example, because most of the financial assets are not linked to securities, not even mortgages. They are on the balance sheets of banks, and accounting rules there are based on accruals, not on mark-to-market. Okay, we can look at that if you want with more deep later in the talk. But when you mark down financial assets, you start eroding the capital of financial institutions. And that is exactly what we saw. Significant losses all over the world on the capital of financial institutions, estimated to be above 700 billion by now, and they will continue. So it's a great hit to the capital base of financial institutions. That in turn actually prompts a deleveraging process, which is what we've seen. Everyone trying to sell assets to lower the asset base and have their capital ratios again in balance with the assets that they are running. But in the process of deleveraging, they create significant problems on the liquidity of the system, and it actually leads to the bankruptcy of several institutions. And we've seen that. And again, that process in turn leads to a credit crunch, and that hits again the prices of houses. And the cycle continues. And it's a negative cycle in which we are. What is the way you actually break this cycle? Only through public policy responses, like we've seen from the Fed, from the Treasury, and from several other governments in Europe and in Asia. What have we seen? Because you haven't seen what we just discussed. What the world has seen so far is that there was a problem in housing prices in the US and something called the subprime, which created, of course, an economic slowdown that started in the summer of last year when the 2 funds run by Bear Stearns actually went bankrupt. And then what we saw was the first wave, hitting the large banks, global banks in the US and in Europe, the downgrade of the CDOs and CLOs, the mark-to-markets, the beginning of the problems on liquidity, and the rescue of Bear Stearns. And that ended up probably in March of this year. The second wave hit regional banks in the U.S. and Freddie and Fannie. And that ended up in September when the U.S. government had to actually rescue Freddie Mac, Fannie Mae, AIG, the largest insurance company in the world, and allow Lehman Brothers to go down, to bankrupt. Middle of September. The third wave started to hit Europe. Whole countries like Iceland, not the banking system, the whole country, in big problems. The Benelux, Belgium, the Netherlands, Luxembourg, having to rescue the banks. The UK announcing the first recapitalization program in the world, which is a partial nationalization of the banking system. Spain announcing ample liquidity measures to support the banking system. And you can go on and on and on. And the last wave, this just hit after Lehman, emerging markets. This is how the world has seen this. And this is why everyone is concluding this is a problem that relates to the subprime problem in the US. It's not true. This is just how we see the news. The truth is that imbalances were being built over the last few years. And they have to actually stop. And they stop normally erupting into a financial crisis. It started in the US because the US have more transparent markets and because mortgages have been securitized. But the housing bubbles were present in Europe as well. This is probably a different way to look at the crisis that you normally have heard in the newspapers. Where are we now? This is the red line. Compare that to the 3 worst recessions and days after the peak was reached on the stock market. And I'm using the Dow Jones for this. We are not doing that great. But hopefully, and different from what happened in the Great Depression, which is the yellow line, the public policy responses, which were not present at the time of the Great Depression, will start creating a point in which financial markets don't go down that much. That only can happen if the financial markets anticipate that sometime in the next year, maybe between the second and the third quarter, the housing sector in the US will reach a stability, meaning prices will not fall down anymore on a national average basis. If that doesn't happen, then we are dealing with a much more bigger crisis than what we think. You can follow this. All the statistics are there. What happened at the end was that investors were scared. They were losing a lot of money in different type of assets. Actually, this crisis didn't have a safe haven in terms of geographies, because it was happening all over the world. And it didn't have any safe haven in terms of asset class, except for the US Treasury. You see the outflows from emerging markets. And we follow this every week, because that's part of our business, to understand what is coming. What can we anticipate? And everyone looking to the Treasury bills short-term as the safe haven. And dropping, of course, quite significantly the interest rate, up to the point that they were basically saying, don't pay me any interest, just give me a Treasury bill, because it's quite close to zero. You are at a great moment, and I'll repeat that at the end of the talk, because what you can learn from what is happening today is going to serve all your life, as it did with my class. because you now are witnessing something that is so important to understand in terms of economic cycles. No matter what part of the real world economy you decide to make your career on, this is a great moment to learn. And you are at the right place, of course. So emerging markets for a time seem to be decoupling. Of course, I keep saying to my friends, you can believe in decoupling or in globalization, but not in both. And this is a test. Emerging market growth was struggling with rich countries' financial crisis. But at the end, everyone is interconnected. And globalization, of course, is the one that is showing us that at the end, no one can escape from this. You can do better than others, but everyone is going to be harmed somehow. Let's go very quickly to Latin America. Before Lehman, and probably the financial world will start talking about before Lehman and after Lehman, because that was really a turning point on the crisis and in general on the way we've seen economic and financial variables behave. Even before the Lehman bankruptcy, the market was, of course, distinguishing very well between very high-risk countries in Latin America, the case being Argentina and Venezuela, and low-risk countries like Mexico and Brazil. But look at what happens after Lehman. The perception of risk became much more important. The risk aversion actually grew enormously all over the world. And so it magnified the risk differential, the risk premium that you had to pay to hold papers in those countries. It is quite amazing. Somehow the world has moved on a pendulum from a disregard for risk to become very risk averse. None of the two are sustainable. But this is how crises work. And on working like this, it opens extremely good opportunities for business leaders and even for all of you as investors. We'll touch upon this in a few minutes. And of course, at the end, international investors flee from emerging markets. This is the case of Mexico and Brazil. And this is the stress that they created on the Mexico peso foreign exchange market and on the Brazil real foreign exchange market. In just 3 days, the two currencies of the largest economies in Latin America shot down 27%. A tail risk event, supposedly not to be happening, as the subprime, as many other things that we've seen, the black swans, present now in all financial markets in the world. For a 27% movement on the foreign exchange, I think you are talking about, in most risk management models, 10 standard deviations. And that is a great lesson from this crisis, because risk management models are built on mathematical formulas, and many of them do not take into account human behavior. This is one of the great lessons from this crisis. And in Latin America, you can see in some countries, not in all, I put just Colombia and Mexico, again, a problem of over-leveraging in some sectors that is starting to be shown. So it's not just the developed world. Some developing economies, some emerging markets were also starting to run into an over-leveraging position in some of the sectors. What has happened with Latin America? You see two countries, the two largest economies, growing at at a moderate pace, you'll see the rest, but with very sound macroeconomic policies. And Brazil starting to grow much more faster than Mexico. Then you have two countries which have unsustainable policies. And they are the ones who are going to be tested, especially in this period. Venezuela and Argentina. And this is why the differentials in risk go so high. The markets will test these two markets especially. Those are the markets in Latin America which we have the most concern. What is going to happen on the economic and financial world. And then you have three other countries, Chile, Colombia, and Peru, behaving very well. Growing very, very fast for Latin American standards and opening markets all over the world, especially with Asia. And Asia is the region of the world that is going to suffer the less in this crisis. So again, quite different paths of behavior even in the Latin American region. And that will be exacerbated by the crisis. The crisis will make a difference in terms of which country has actually done their homework in terms of macroeconomic policies and financial and fiscal discipline. Let me finish with a couple of things. First, what to expect in terms of future trends on the financial industry. And I'll talk about 5. The first one is the leveraging and consolidation. We'll see, of course, much more lower leverage ratios because the market will not accept as high as it was present before. And that probably is bad news for investment banks and for hedge funds because they were based on business models that were basically based on very, very high leverage ratios. And that is why I put their business models. A very high leverage business model like investment banks is not longer accepted in the market. This is why Lehman, Bear Stearns have disappeared. Merrill Lynch is now being subsumed into Bank of America. And Goldman and Morgan Stanley are becoming bond holding companies. It is the business model that is at test here. And it's the business model that the market is not accepting anymore. And we are going to start seeing the same with some of the hedge funds. Because they are based in very high leverage and very low price for risk. Now, for all of you who have studied Finance 101, with maybe following the book of our dear Professor Jim Van Horn, or some of the faculty from Stanford, you will understand that risk-reward needs to be present all the time. If there is not sufficient return for risk, the market will correct eventually. This is what we saw. Risk management and innovation. As I said, one of the lessons is that risk management models now have to change. And they have to consider the tail risk events, the black swans, as part of how the financial industry and the economy behaves. They have to take into account human behaviors, from greed to fear. This is the way it works. It is not the way risk models were built before. And that led to what we have seen. Corporate governance will change. This is something that will be, of course, much more demanding. Having somebody on your board that does not understand the financial industry is probably not going to be that acceptable in the future because there will be much more pressure on the boards of the large financial sector. And finally, of course, there will be significant changes on regulation and safety nets. The pendulum can move actually to the other extreme, and that will be a risk. More regulation is needed, but not in excess. That will kill innovation and some form of significant competition. So those are some of the things that we can expect to happen in the next few months, quarters, 1 or 2 years. And quite a change on the business models that will be successful in the future. I will expect that that debate will continue, whether universal banks or some form of a special financial institutions can live together, whether it's the business model or is the execution that makes a difference. That debate will continue. And you will be, of course, hearing more and more about this. In terms of innovation, the issue of suitability, who can actually hold and understand correctly the risks on derivatives, structured notes, structured products, more complex financial instruments, will be at the center of the discussion. Let me move finally on some of the lessons that I've learned along financial crisis. I think this is the 5th crisis that I live in my career. Being a Latin American and a banker, of course, you know a little bit about crisis. The first one is you have to understand economic cycles. As I said, if you talk to somebody in Wall Street in 2006, I'll bet you that half of them will say economic cycles are part of the history, are in the past. They thought that liquidity was going to always be present. They thought that credit could continue to be expanding with no limit. Economic cycles are always there. And those of us who understand this well can actually profit from it, as I said, as business leaders and as investors. Because we understand what is coming, and eventually it will happen. Maybe we will not see a crisis of this magnitude in the rest of our lives. Maybe. Because this one is, as I said, as Alan Greenspan put it, once in a 100-year crisis. But crises will continue to come. And if you understand this, you can actually take advantage of it. It's the nature of a market-based economy. Crisis. It reflects part of the human behavior. And being quite optimistic at one point and quite pessimistic at another point. And just remember what Warren Buffett says about this, because this is part of the golden rules, both for business leaders and for investors. Be fearful when others are greedy, and be greedy when others are fearful. For many investors in your age, this is the time to invest, not to hold cash, which is exactly opposite to what many people think. For the business leaders that did well, this is a time to buy, to acquire other competitors, portfolios of assets. This is the time. The second lesson, of course, and this is one of the principles that I have followed all my life, is something that Peter Drucker says. Look at the world as it is, not as we would like it to be. This is an essential rule. We try to see the world always the way it will be more convenient to us to look at it. That's not the managerial discipline that you need. To be successful, you have to apply a reality check every step in your life. Look really at the world as it is. I think that's what I have found in many business leaders to not be present, and they eventually fail. It's a key discipline, it's a key to success. A third one, superior analysis always makes the difference. I remember when I was at the business school here at Stanford, and there was a course that a financial professor named Jack McDonald taught at that time, and it was called superior analysis. At that time, at Chicago, at the business school of Chicago, there was a lot of professors who had developed the efficient market theory, which says there is nothing you can do about analysis that will beat the market because everything that is there is already embedded on the price, on the markets. Well, I think Jack McDonald and Warren Buffett had proved them wrong. And if you look at the financial sector, but it's the same in any business sector, you see the best business leaders have a superior analysis. An analysis that allows them to be well prepared, to anticipate what is coming, and to choose what to pursue and what not to pursue. The crisis has hit all the financials, but in a different way. All the financial institutions. And some of the best institutions actually stay out of the crisis completely. A couple of examples, JP Morgan, Wells Fargo. Bob is on the board of Wells, but I have always admired Wells Fargo. And one of the CEOs of Wells put it this very clearly. He said, part of my job is to make sure we don't attend parties that make no sense. That was a surprise. As business leaders, this is a very important lesson for all of us. If you had done your analysis correctly, you will not go to that party. Or probably you will leave the party earlier. Big difference. 3 more, and then we finish. Act decisively, of course, to seize opportunities. Once you have a better position on a crisis, when you enter the crisis, it's all about relative positions, because you will emerge on a much more strong basis. But you have to act decisively. Crisis generates a lot of opportunities. A properly managed crisis will produce for you and your company a resumption of growth much more faster than your competitors with a much more strong position. But we are seeing this as we speak. One of the things that I have always followed is this. When asked about what makes a business leader successful, is the strategy, is surrounding yourself with the best talent available, is being a very good manager and follow a very thorough management process. I would say is a combination of the 3. This is a role that I always discuss with everyone that works with me. This is what makes our job quite challenging. But you have to be part of devising and designing the right strategy and updating it. You have to be able to attract, retain, and develop the best talent that you can and surround yourself with talent and run a very disciplined managerial process, setting goals, measuring results, and rewarding performance. The 3 need a balance. The 3 need to be there. And a business leader can only succeed if he sees that the 3 of them are at the best form. And finally, at the end, it's about culture. It's always about culture. Institutions always are better because of the culture that were installed and developed by their leaders. That's what makes high-performance institutions. is constant change, constant learning, constant improvement. Without learning, there cannot be improvement. As I said before, this is a great moment for you. You have the opportunity being here to really understand and learn about this moment in the global economy. Invest time on that. Really try to understand the behaviors. And that will be a very valuable learning for all your life. Historical events change, of course, attitudes, paradigms, behaviors. It was the case on the Great Depression, the World Wars, even September 11. The present global financial crisis will not be different. But you can anticipate this. And you can really master how crises affect the business world and, for that matter, the whole economy of a country or, as in this case, the world. What you can learn can change your professional careers. And being here at Stanford is quite appropriate, because with that you will continue to change lives, change organizations, and change the world. Thank you.
You mentioned how public policy will make this crisis different from other crises in the past. But, I think public policy instruments are not in the best moment right now, with interest rates at 1%, the fiscal deficit already too high. Do you think there's still room for the implementation of other instruments that would help to get out of this crisis?
The answer is yes. Some of the policies that have been implemented already are on the right direction. It will take time for them to work. Okay? On the monetary policy, as you rightly pointed out, going down from 1% maybe will not make a big difference. But being at 1% already is going to make a difference going forward. Now, there are a lot more policies that have been implemented that are actually starting to work, helping to create liquidity, helping to restore trust between financial institutions so that they can start lending to each other again and have the interbank market moving again, and with that, other credit markets. But public policies can still be, in the future, new policies that will make a difference. And let me mention just 2 or 3. When you have a market in which it's so difficult now to understand what is the capital of each financial institution, because again, on the asset side you have mortgage-backed securities or mortgage loans. One on securities, the other one on the loan portfolio. And you don't know the value of the house, then you don't know the value on the capital side. The only participant in an economy which prices of houses are coming down, liquidity is eroding, trust is not there. The only institution, for example, that can actually start to buy this type of assets, hold them for a significant period of time to be sold later and not have to report the next quarter, is the government. They have the money. Look at the Treasury bills rate. Almost no funding cost. Significant amounts of money. And they don't have to report to the stock market the next quarter results. They can hold these assets for a few years, then sell it back at a gain. That was what it was behind the TARPS program. things became so bad that they had to use the money to recapitalize the banking system in the US. But eventually, they can actually trigger a program like this. What is the aim of that? And what is the aim of all this? To reach stability in the housing market. If prices continue to fall, the financial system will continue to be on a credit crunch. You need to get to stability in the housing market. Then you will exactly know how much value is still in the capital account of banks. Otherwise, you have this big uncertainty. So there is room. There is room for some other policies, even if the interest rate part of the monetary policy is almost at the end. Please.
You talked about the rates of the T-bills being that low because of this flight to quality effect. And at the same time, one could also explain that due to a potential view from the market that there's going to be some sort of deflation. And that it's also related to the fact that some of the inflation-linked bills are also have a spread relative to that. So how likely do you see a scenario of worldwide deflation, and how would that eventually affect Latin America being a region that's more driven towards the input side of the economy?
I do believe that there is a possibility. I believe at this point is not that high. Not that high. One of the things that we are seeing, of course, is that the prices of commodities are coming down after they went up almost 3 or 4 times in the period that we talk. But I believe there is a good probability that the U.S. economy will start to turn around sometime in the second half of next year. And with that, the world. The U.S. represents 25% of the world economy today. If you add Europe, that's about 55%. What is important is the U.S. will be the first to go in, probably with the exception of the U.K., and the first to go out. Europe will take a longer time. If we have the world moving again, then the deflation possibility really starts to disappear because there will be enough demand to move the world. One of the good news, of course, is emerging markets. China will slow down quite significantly, from 11% to 9%. But wait, if you reach 7% in China, that's recession over there. It's what they tell you, no? But I think that we have China, India, and in general Asia as a bright spot. And they will continue to drive demand. So I believe, again, there is a possibility, but not a high probability for the deflationary scenario.
I just wanted to ask you, 7 years ago, and sort of related to Armando's question, Alan Greenspan made the decisions and then came back a couple of months ago, and well, he had all the information, the best analysis in the world, and he said that he made a mistake. Now that we're learning and we're starting to learn this analysis and tools, what do you recommend us? What guides can we use to well, as a safe word for our analysis, and to be sure that we're not on the wrong side?
Well, I think financial markets are a good judge of this in general, because when you have stocks going up so much, you have to understand that they are becoming more risky, not less risky. And when they go down, is the reverse. See, this is what is probably so difficult to understand, but people like Graham and Buffett and many others have dominated about the crisis. The indicators are there for people that want to see them, for people that look at the world as it is, not as somebody would like it to be. And this is exactly what was present for many people. PE ratios so high, prices so inflated. That is probably when you had to be fearful, because everyone else is being greedy. And the reverse. Those are some of the indicators that you can use. Thank you very much to everyone. Thank you.